Good afternoon, everyone. Today's session is going to be focused around generational wealth transfer, and in particular, looking at strategies for inheritance tax. For those who don't know me, my name's Mitch Young, co-founder of the Fusion Consulting Group, and also those that know me through social media as Mitch the Taxman. The Fusion Consulting Group is essentially a professional services group which we've built for families and entrepreneurs so that they have all their core services and advice in the one company, acting as their mini private office. So we have in-house accountants, tax advisors, lawyers, and wealth managers. I co-founded the business. I'm also a qualified tax practitioner, regularly advising on client matters, including intergenerational family transfers, corporation tax, inheritance tax, and a variety of different tax advice. So net wealth is essentially not treated equally across everything. We've got the taxable capital, which is where we're taxed in lifetime on property, cash, investments, and these are essentially fully exposed to a potentially 40% inheritance tax. You then have what's called qualifying capital, and these are assets which can qualify for or potentially qualify for certain types of tax reliefs. So that will be your typical trading businesses, farmland, and other business assets. And then structured capital is what we call capital, which is sort of invested in a specific structure, such as a trust, family investment company, which we'll talk a bit more about, and partnerships. As we know, there is a great wealth transfer happening in the UK and around the world at the moment. It's expected £5 to £7 trillion is passing between the generations. So tax planning matters more than ever before because, of course, asset values have increased, which means a tremendous amount of wealth and assets are being caught within the inheritance tax bands. Thresholds for inheritance tax have not increased for a tremendous amount of years. The nil rate band remains at the £325,000. The values of assets across real estate and investments have significantly increased, and particularly in recent times, HMRC scrutiny in terms of data and asset and values have increased. So now, more than ever, people are sitting on estates which are being subject to 40% tax. So where are we in terms of the UK inheritance tax landscape? So we're seeing fiscal drag essentially bring more estates into inheritance tax, as mentioned. There is also a significant reduction in tax reliefs, which were announced last year and are currently come into force as of April 2026, in particular around the transfer of family businesses and shares to your children and the next generation. Previously, one could transfer their shares in their business to their beneficiaries free of inheritance tax, no matter what the value of the estate was. Now, these are subject to a cap of £2.5 million of value can be transferred, 100% inheritance tax free, and then the remaining value is subject to a reduced amount of inheritance tax at 20%. This led to a lot of business owners restructuring prior to April. And of course, now, if you're sitting on a business value over and above £2.5 million, then your estate is currently exposed and planning is to take place. This is similar to agricultural property relief in relation to farms and farmland. And now, of course, we have from April 2027, pension pots being bought in as well to an estate. So a lot of clients, a lot of business owners have built up very large pension pots with a view that they'll be able to pass them on tax-free to their beneficiaries. And now we're in a bit of a tricky situation whereby, you know, these pension pots are going to be added to the estate and then subject to a potential 40% inheritance tax charge on this as well. So the UK has been quite aggressive in terms of reducing and bringing things into the inheritance tax trap. So I guess the risk of doing nothing is that your estate could be potentially subject to inheritance tax. A £3 million estate potentially pays circa £700,000 of tax. And basically what would happen is that if your estate is subject to inheritance tax, probate essentially would need to be passed and the tax would need to be settled before the estate is distributed to your beneficiaries. Now, of course, in a cash-rich, in an asset-rich, cash-poor situation, typically what happens is that the funding of the tax is typically either via a sale of an asset or some type of liquidation, potentially. And it's a question of really, you know, does one feel comfortable, you know, having, or their estate having to pay that tax and potentially their assets becoming unwound because of a very, very large tax charge. But I guess the good news is that with careful and considered planning, the wealth transfer, i.e. the transfer of your assets to the next generation prior to death, can still take place. And with sensible and considered planning, inheritance tax can be mitigated. In terms of some common mistakes, what we see in practice an over-reliance on a client believing that their will, you know, covers inheritance tax planning and, you know, not having the right structures or things set up on death. There's clearly been no lifetime gifting strategy throughout the lifetime. Clients that leave it too late. And a big one, and we'll come on to some of the reliefs as well, has been around a misunderstanding of the tax reliefs available. It's very difficult as an advisor when you are dealing with a post-death family situation where there is complex and high taxes. There's a lot of emotional involved, a lot of financial cost involved, and strain involved. So from an emotional perspective, it is very wise to consider planning for your family prior to this. In terms of, you know, actual what planning can be done in modern day society, it is tricky. It is tricky because, of course, the whole concept of wealth transferring and inheritance tax is about gifting from you to someone else. So typically, if that person or structure is anyone but your spouse or civil partner, that often creates another tax charge. So that may be capital gains tax, it may be stamp duty. You may still need to rely on certain income. So there's things like gifts with reservation of benefit. You know, a typical situation would be, I want my main asset is my family home. I want to gift that to my children, but still live in that property. Well, that would be caught by the gift with reservation rules. So that would bring it back into the estate from an inheritance tax perspective. So that would so that wouldn't work. But that's just one example. Creation of artificial structures. Obviously, you know, if things are too good to be true, they probably are now in terms of tax. So, you know, all these sort of crazy structures that previously might have been is, you know, would no longer fly. There's a loss of anti-avoidance across tax, a loss of compliance across tax. You know, people may say, well, you know, I think my property is worth 700,000, but whereas an estate agent, you know, is valuing it at 900,000. So we're gonna, you know, put the value as 700,000. But again, that would essentially you know, fall foul of HMRC anti-avoidance rules. HMRC has a lot of data. And then, you know, with the more sophisticated type of structures where you've got a family business, and we're doing a lot of this type of planning where you've got the, say the parents who might be in their sort of, you know, late 60s to late 70s, you know, they still want elements of control when it comes to the shared distribution. So again, you need to look up settlor interested position, the gift of reservation rules. So, you know, it is harder nowadays, but it's not impossible. And working within the realms of the legislation, understanding your options and safeguarding your position is still achievable. What we actually tend to see is sort of mini plans. So you may have your 1 to 3 or 1 to 5 year plan, which you're going from, say, 0% inheritance tax efficiency to maybe 60% efficiency, and then you perform that plan, and then in year 3 to 5 you have stage 2 of the plan, and then you're gradually working towards a strategic plan that will get you to where you want to be. So if we just come on to some three core strategies which potentially we can look at. So the first is obviously lifetime gifting. So it's a simple strategy which involves gifting, and we're looking here at the gifting of monies on the whole. So essentially, when you gift something to someone, you have 7 years from the date of the gift for it to sit outside your estate for inheritance tax. Obviously, I mentioned around the interaction with capital gains tax when it comes to other assets. So just note that as in the back of your mind. In terms of some basic rules and planning, everyone can give sort of £3,000 per year as a gift. If you haven't done that the year before, you can double up and gift £6,000 a year. And that would just sit outside your estate. You don't need to essentially worry about the 7-year rule. One of the core strategies I wanted to mention and just talk about a bit is what's called the gifts out of surplus income, or gifts out of normal expenditure of income. So this is whereby it's I guess a little known tax relief whereby let's say you've got your rental portfolio and you've got 2 or 3 pensions, and you're living off your rental portfolio, that's maintaining your standard of living. So if you were to do your personal profit and loss in a year, your rental income is delivering you, I don't know, let's just say £40,000. Your expenses for the year are, say £30,000-40,000. So you're clearly living off that rental income. Then let's say you've got, let's just say £10,000 coming in of pension income. That pension income, you're not using it to essentially maintain your lifestyle. So then essentially you could gift that £10,000 of surplus income to your beneficiaries throughout your lifetime. And that would, again, sit outside the estate and not, be bought in from the inheritance tax position. What you need to do from a record keeping perspective is ensure you regularly got your personal profit and loss, and then maintaining accurate records across the distributions. The next strategy involves trusts. So trusts are an important part of a family's wealth transfer and estate and legacy planning. Trusts, and there are a few different types of trusts, but generally speaking, a trust is a separate legal entity, like a limited company, but not a limited company, separate limited company. And essentially, when you put an asset into trust, you no longer own the asset. The trust owns the asset, and the asset is for the benefit of the beneficiaries. The beneficiaries might be your children or grandchildren. So it may be that you start to put assets into trust. The trust will have its own nil rate band. So that will have its own nil rate band of 325,000. So in theory, you could put an asset or monies into trust of £325,000 without there being an immediate charge to tax. Once an asset is into trust, the trust sits outside your estate for inheritance tax purposes. But one of the core reasons as to why people would utilize a trust is to try and protect the family's bloodline, because a trust is pretty much one of the only things that one can establish to protect against divorce and bankruptcy and things like that. So this is commonly used within a family structure and to assist with the transfer of wealth in lifetime and post-death for families. There are a number of downsides to having a trust. So again, you'd need to look at the calculations. Obviously, what we're trying to do is we're trying to mitigate inheritance tax, and we're trying to start the process of legacy planning for the family and the next generation and the generation and generation. But there are taxes and accounting charges and things like that you'd need to understand when it comes to a trust. Yeah, we could do a whole separate webinar in that, but broadly speaking, there are sort of a 10-yearly periodic tax charge that one would need to factor in, which sort of equates to around 6% of the value less the nil rate band to be considered. The trust itself will have its annual filing responsibilities. If there are any income being generated from the assets in the trust will pay its own tax. And the beneficiaries, if they are to extract income from the trust, they will be subject to tax on the income, and they need to declare it, but it will come with a tax credit to it. Any assets going into the trust over and above the available nil rate band will also be subject to what's called a chargeable lifetime transfer, which is essentially a lifetime transfer tax, an immediate charge to inheritance tax on that value above nil A band at 20%. So this is where obviously careful planning and agile planning needs to be taken into account, along with financial modeling as to what can and can't be done. Now, the good thing about the availability for business property reliefs and other reliefs is that, let's say you have a trading business and you wanted to put, say, some shares into trust, then potentially that immediate charge to tax at 20%, that inheritance tax immediate charge over the nil rate band, potentially will you be able to qualify for that inheritance tax relief, BPR, business property relief, and put more value above the 325 up to, say, 2.5 million into trust. The next strategy is looking at a number of reliefs available. So we spent, quite a bit of the webinar will be going for half an hour. So we've already spoken for around 25 minutes. We've spoken a lot about the availability of the business property reliefs, agricultural property relief. So I don't want to sort of dwell on that point. I think everyone sort of understands about the availability of that and the importance of those reliefs. What we'll come on to is essentially when business property fails, because we are having a lot of consultations around this. And there's a couple of situations to be careful of. The first is assuming that if you have any type of limited company, then the value of the company or the assets are going to fall within the business property relief. So this is incorrect, and particular where HMRC distinguish around what's qualifying business activity and what's investment activity. And of course, this typically applies where you have property. So buy-to-let properties are pretty much standard. Buy-to-let properties are pretty much always treated as investment in the eyes of HMRC. The other situation is an unfortunate one whereby, let's say you have a totally trading business, whatever industry it's in, fully trading, and it's a successful business. And over the years, you've done well and you've built up a very large cash balance on the bank account. Obviously no fault of your own. It's just been sitting there and accumulating. If the value of that cash exceeds 50% of the value of or the turnover of the business, then HMRC actually will deem that as an investment business, and the whole qualification of the business property relief will come crashing down. So that is something that you would need to be consistently monitoring as you work through your legacy plans with the cash flow. What have we put on here? Yeah, nothing much there. So when should planning happen? And I've done this sort of generic guide, I guess. So of course, you're building your assets, you're building your businesses, you're building your investments stage one at the ages, very generically from 30 plus, let's say. Structures should be built, from 40 to 50 would be a good age to sort of start looking at the different types of structures available to you fixed, transfers, partnerships. And then transfers should be starting to happening in terms of the gifting, income planning, gifting of shares and assets from sort of 60. Obviously, that's just a rough guide, but that's sort of what we see in practice. This is a standard drawing that we look at, and essentially what typical type of family investment company situation we look at and build for our clients. So at the bottom, you've got a number of different businesses, if you like. So you might have your trading business, you might have an investment business, you might have a property business, commercial mixed unit, whatever it may be in your different subsidiaries. That essentially would be owned by a holding entity, and we would call that entity a family investment company, which is just essentially a posh word for a holding company. And then the allocation of the shares of the family investment company might be the parents and the children. Typically, the children will have slightly different classes of shares than the parents. That will be dependent on their involvement. And the different classes of shares would mean that, they would be able to have dividends at different times to the parents, and they might not have voting rights. But also there's a concept we look at around growth and freezer shares. These have to be structured carefully. What it means is that the value on day one is X. The parents' value, let's say that's 4 million, gets frozen. Then any future growth in the business, the trading group, gets put into the children's value of the shares. So the parents' value constantly will freeze at 4 million, and let's say over the course of 10 years the company's worth 10 million. That additional 6 million of growth will be in the share value of the children, and that is a way of not necessarily mitigating the 4 million, but it's mitigating the essential 6 million on the future growth from an inheritance tax point of view. And then the diagram on the left looks at, on the right, looks at same diagram, adding in a trust as one of the shareholders. So, I've made it sound very simple, but there's, there's a number of factors and nuances to actually get to this position. For those who joined late, there is a sticker in orange at the top of the chat bar where you can book in a Calendly booking slot with my colleague at a time that suits you, and he will arrange a initial consultation with myself where I'll spend 20 minutes, 30 minutes with you, understand your situation, give you some general advice, and then if we feel we need structuring, I will follow up and quote accordingly. I always work, just so everyone knows, I always work towards a fixed fee for all my work. What I do is I map out a number of different options and solutions based on what you're thinking, and then we agree a fixed fee for that. Obviously, of course, the investment in me, every single calculation and computation we're doing will essentially illustrate tax savings. So certainly when you're dealing with wealth transfer, inheritance tax, the investment in what you pay for a good tax advisor, the savings will significantly outweigh the payment of that fee. So some key tips and takeaways of what we're seeing in practice. Okay, obviously the whole method, the whole message here is to start planning early, use multiple strategies. There's not a one-stop shop for this type of planning anymore. Seek expert advice. Some of the other things we're seeing is the use of debt. So when we come to estates, we look at the taxable value is on the net estate. So we're seeing more leverage being taken out against assets in an estate to reduce that liability, the increased liability which is going on for businesses, and obviously the increase of the pension in there. Life insurance. So life insurance can be written into trust, can be used to pay for whatever that inheritance tax bill may be. So often we're doing our planning, we're doing that 50-60% day one, topping up the rest with life insurance, and then pivoting after, say, 3-5 years, or reducing the policy down accordingly. We've got a wealth management team in-house, and they can certainly do a whole of market quotation for you and get you the best option when it comes to life insurance. So of course, please do reach out there. And also with life insurance, just remember that if you have a limited company, if you take out the right policy with life insurance, or what's called relevant life, the company can pay for the life insurance and it won't be a taxable benefit in kind. The other thing we've looked at is around family partnerships. So you might not be in a position to establish a company, but you can look at a partnership where you might have an older parent, and that could open up the options for tax planning and debt advisory. So yeah, thank you for your time. Please do feedback to us, and of course we want to help as many people as we can protect more of what they earn. So do get in touch with us, and it'd be a pleasure to hear from you and work from you, and hopefully look forward to seeing you at the next one.